Hello friends, my name is Behroz, and in today's video I will talk about what are the tax implications on your stock investments when leaving Canada, and especially when you are leaving Canada and moving to US, because there are two kinds of tax implications. One are tax implications related to Canada, which is with CRA, and the other is tax implication related to US, that is with IRS. I will specially talk about your stock investments in unregistered accounts, your stock investments in RESP, in RRSP, and TFSA. And I will also be talking about implications related to investments in mutual funds. So I will cover all of this. Now, the reason I have come out on the subject is because 2 years ago, I moved from Canada to US and had to go through the entire learning process, understanding the taxation impact on property, on investments, stocks, mutual funds, and all. By the way, previously I've made a video where I explained the tax implication on your principal residence. We assume that principal residence is tax-free in Canada. Well, when you're making a move, it might not be tax-free anymore. Hence, it's important you check out that video as well. Now, with that said, before we move into the video itself, I have special ask for you. One, press the like button, as this will help me improve the quality and the quantity of content that I post on this channel. And second, press the subscribe button if you've not done it already, so you get notified as soon as I put a new content on this channel. On this channel, I post content pertaining to how you can go about achieving career success and personal finance success. So in case you're interested in these topics, make sure you subscribe to the channel as well. Now, while in this video, I will be explaining the implication of taxation on each of these accounts, it is also important to note that in this video, I will be also explaining you how you can go about optimizing your tax bill. I've done a lot of learning and study on this already, so you can make use of my education and my study on this particular topic, which I will be summarizing in this particular video, so you can go about optimizing and reducing your particular tax bill. Also in this video, I will be sharing with you some of the legalities or some of the requirements in terms of reporting that you need to be aware of when you're moving, especially to USA. There are certain requirements that you need to be aware of for each of these particular accounts, call it RRSP, TFSA, RESP, for which you need to be aware of, because you will be required to do those reporting when you're filing taxes in US, and hence it will be an additional cost. One, for filing those additional forms in US, and second, in case you miss any of those forms, then there will be penalties. So you want to avoid penalties, and also you want to be aware of the cost that will be incurred just because there are additional filing requirements. Now, starting with unregistered accounts, this is your stock investments which are not with any registered account like RESP, RRSP, TFSA, or so much so as FHSA as well. These are your stock investments that you're holding outside these accounts. Well, for all of those stock investments, you will need to go through deemed disposition. What this means is that on the day you are exiting Canada and moving into USA, that day you will have to calculate or understand what is the value of your stocks in that particular day based on the latest market value, and assume that as if you've sold those stocks. So whatever capital gains you've gained since the time you bought the stock till the date you're moving to USA, all that capital gain is taxable in Canada, and you have to pay tax on those gains in the tax year you're moving from Canada to US. So let's take an example. Let's say in 2021, I bought a stock for $100, and in 2022, let's say on June 1st, when I'm moving to US, the value of the stock is $150. So the capital gain is $50. Even if I don't sell the stock and I keep the stock, I will still be taxed on that $50 in that particular year. In the tax returns that I will file for year 2022, I will have to pay tax on that $50 gain, which will be a capital gain tax that I will have to pay in Canada. So even if I'm not selling the stock, I will still have to pay capital gain tax in Canada, because the stock has been assumed to be dispositioned or deemed to be dispositioned. Now, while this is not a good news, because you will have to go through tax liability in Canada on a stock that you don't want to sell or don't intend to sell. However, the good news is that in case of US, your stock base will be now $150. So your stock base won't be $100 anymore. So in US, when you start, and let's say that value of the stock goes from 150 to, let's say, 180, now the capital gain tax when you sell that stock while being in US at price 180 would only be $30 capital gain, and you will be taxed only on those $30. You won't be taxed on $80 from 100 to 180. You will be taxed from 150 to 180. So that $30 gain will be taxable based on the capital gain tax in US, which means essentially you're done with your tax liability in Canada on those stocks because you've paid the tax, and now you are only left with your tax liability in US, but starting from a new base price. So even if you didn't sell the stock, your new base price is $150 and you calculate your capital gains starting at $150. Now let's talk about RRSP. RRSP is very simple. RRSP will continue to be treated as a tax deferred account. Any investment that you have in RRSP, you don't need to report it at all. There is no deemed disposition for any investment in RRSP. And also any gains that you have in your RRSP, either through capital gains or through dividends, are not taxable till the time you take that money out. It is only when you take that money out, you will have to pay tax on that money in Canada and then in US as well. Again, there is double taxation treaty, so you will have to pay differential tax in US after you pay your tax in Canada. But the taxation implication only applies once you take out money from RRSP. As long as money is within RRSP, it is fine. By the way, this also means that you can continue to trade within your RRSP account. So if you have a broker in Canada and you have an RRSP account with that broker, and you can continue to then trade within that account, like buy and sell stocks, and there is no implication on those buying and selling stocks. However, as I talked before, with regards to unregistered account, you cannot do any trading any further with your broker in Canada. If you want to do further trading with your unregistered account, well, that is not possible. You will need to move that money out of your unregistered account and then move it into US, and then you can trade with a broker in US. Now, it is also important to note that you cannot actively trade with your unregistered account that you have with your Canadian broker. What I mean here is you cannot buy and sell stocks. Well, essentially you can sell stocks. The stocks that you currently own, you can sell them, but you cannot buy new stocks. So if you want to trade using that money, it is best that you liquidate all your stocks, move all that money to USA, and then invest with the broker in US, and then do the trading with the broker that you have in US. You cannot use your unregistered account in Canada and trade there. Again, just to explain, what I mean by trading is buying stocks. You can sell anything that you have, but you cannot buy. Additionally, you can continue to gain or earn dividend income, but any dividend income that you earn on those investments, that is taxable in US now, because there is no taxation anymore in Canada except for withholding tax. So Canada will charge you withholding tax on any dividend income that you earn with the investments that you have with the broker in Canada, and then you'll have to pay taxation on that income in US as well later. So it is best, if you've decided to live in US for long term, that you kind of liquidate all those investments that you have with Canada and move it to US, where you can actively trade them and avoid this withholding taxation that will occur in Canada on those dividend income. While any capital gains that are coming on selling your stocks that are with your Canadian broker in the unregistered account, you don't have to pay any tax anymore on it in Canada, because you've already done your deemed disposition. You've already paid the capital gain tax based on the value of the stock on the day you were leaving for USA. Now, any capital gain that happens when you sell any of the stocks in the unregistered account in Canada, you will have to pay tax on that capital gain in US now. Now let's talk about TFSA. So all your investments in TFSA will not go through deemed disposition. However, and this is a very important however, which is that when you sell any stocks that you have in TFSA, there will be a tax implication in USA starting from the value of the stock that you bought. So the base price would be the price at which you bought the stock. Let's take an example. I bought a stock for $100 in my TFSA. That value of that stock moved up to $150 the time I was moving to USA. There is no tax implication then. There is no deemed disposition. You don't have to pay any tax on that capital gain. However, now while you're in US, you decide to sell that stock and the value of that stock is $180. You will have to pay capital gain tax on it, and the capital gain tax will be calculated using the base price of 100. So you will have to pay tax on $80. From $100 to $180, $80 would be your gain on which you'll have to pay capital gain tax. Now, the reason this is an issue is because TFSA is inherently designed to give you tax-free capital gains and wealth gains. If you end up paying tax on the gains that you've seen in your TFSA, then all the purpose of investing in TFSA is lost. So here, what you need to do is make sure that you sell anything that you have in your TFSA account before you are moving to USA or leaving Canada altogether. Now here the beautiful thing is that you will not lose your contribution room in TFSA. So if you sell everything that you have in your TFSA account and you take that money out, let's say it's $11,000 that you have, you sell everything and you take $11,000 out, you still have $11,000 worth of contribution room if and when you decide to come back to Canada. So let's say if you come back to Canada after 5 years, you will have 11,000 worth of contribution room in your TFSA, which you can invest those $11,000 exactly on the day or in the year you come back to Canada and start your residency, tax residency again in Canada. So essentially your contribution room is not getting lost. It is better to take the advantage of capital gain that you've seen in TFSA there and then before leaving Canada and moving to US, as against leaving that money in or the stocks in and not selling them, because once you leave it in and you move to USA, now on selling those stocks, you will have to pay capital gain tax and all the benefit of free taxation will be just wiped out. Another painful point with TFSA investment is that any dividend that you're earning on your investments that are in TFSA will be now taxed in USA. These investments were not taxed while you were in Canada, so any dividend income that you were earning on your investments in TFSA, you would not pay any tax on those dividend incomes. But now any dividend income will be taxable. So you're losing that tax benefit altogether, and hence it's better to just liquidate your investments altogether, take that money out and move it to USA. There are other opportunities in USA similar to TFSA, which are tax-free and tax-deferred, where you can make those investments. However, it is best to take that money out from Canada and enjoy the tax-free gain as against paying tax altogether. Now let's talk about RESP. RESP works similar to TFSA as well, which is that any investment that you have in your RESP account, if you sell it, now you have to pay capital gain tax on it in US. This wasn't the case while you were in Canada. If you do any trading within your RESP account, there is no tax liability unless or until you take that money out. However, now just like TFSA or in our case of RESP as well, you essentially don't need to take that money out. If you do any trading, as long as the money is traded, it's sold, there is a capital gain, even if you keep the money within your RESP account, just like TFSA, you will have to pay capital gain tax on it. Similarly, again, similar to TFSA, if there is any dividend income, you will also have to pay tax on the dividend income. So here, my best recommendation is to sell anything that you have in your RESP and just put liquid cash. This is if in case you're expecting to eventually come back to Canada and make use of the RESP account. If you think you will never be coming back to Canada altogether and you will always stay out of Canada and you will not be making use of the RESP account, then it is better to not just sell the investments that you have in your RESP account, but also take out the cash, so you avoid any tax implication. Now, when I say all of this, it is not just that you have to pay tax on those capital gains and dividend incomes that you have in TFSA and RESP. You will also have to do different kind of reporting and filing in US. So for instance, if you are hiring a tax lawyer or tax consultant, tax agent, they will be charging you more for additional form that they have to file on your behalf. So if it's RESP, there will be a different form they'll have to file and they will charge you more, let's say another $100, $200. If it's TFSA, it will be another charge that they will have to make just because they're making another filing, and so on and so forth. So reduce the number of filings you will have, reduce the implication of taxation that you will have, and hence it is better that you sell your TFSA altogether, take your money out, close it, and with RESP, you sell everything that you have in RESP for sure, and if possible also take your money out and close the account if that is the thing that you think that you won't be using that RESP account altogether. Now here in RESP, the question might come, okay, if I take all the money out, what happens to the contributions that you get from the government? What happens to the capital gains? Well, all of that money will be simply donated to the choice of your college or institution. You cannot take that money with you. If you're closing down your RESP account, the only money that you can take with you is the original investment that you did in the RESP account. Any gains or any contribution from the government has to be donated. So you'll have to donate that money. And hence it is best, in my opinion, in case of RESP, in case you think you might be coming back to Canada, is not to close the RESP account, but make sure you sell everything in the RESP account so you are not generating any dividend income and you're not generating a risk of creating a capital gain by selling something later. So sell everything in the RESP account before you move out of Canada and move to USA, so that there is no implication on taxation per se. And later, if you decide that you want to close the RESP account, well, you can close the RESP account, donate that money. Rather, you can get benefit, a taxation benefit in US on the money that you donate from the RESP account. And this donation thing is kind of a requirement from the Canadian government, which is in case you're not using that money, then you have to donate the money. Again, the portion of the money which came from the government and the capital gains. your piece of investment in the RESP account will be handed over to you. Thank you for watching this video. Hopefully this video was valuable for you to now kind of have an idea of what kind of tax implication you can expect on your stock investments when you're moving from Canada to US, and will be able to know better how you can optimize it. In case you found value from this video, I'm sure you'll find value from another video where I talk about what is the best way of buying a car, whether on cash, on lease, on financing, and I compare all these three options. You can check it out here. Other than that, there is another video where I talk about what is the best way to invest in the stock market. You can check it out here. Thank you.